Hey there folks, welcome in here. Two videos to react to. It's a 2-for-1 on the reaction channel here today. First one we're going to get into from Bloomberg. How bad will it get? We're going to watch that. I'm going to give my opinion on that video there. Then we're getting into this one. Has it warns of scary October for the U.S. economy, which could lead to fears obviously in the market as well. So I'll give my opinion on that video as well. If you have an opinion on anything discussed in either one of these videos here today, I would love to hear your opinion in the comment section. As always, I appreciate everybody for joining me. I think we're at like 14,000, maybe 500 subscribers now on this channel. I appreciate each and every one of you for being here and being subscribed. If you're looking to join my private stock group and get access to everything in there, including our Discord chat, where you can chat with a bunch of fellow shareholders of stocks like Palantir, SoFi, Tesla, and many others, get access to our private group investor report, and get access to all my different course curriculums. Check out the pinned comment down there to apply to join us in there. Alrighty, let's jump into this.
The most basic question, how bad is it going to get?
How bad is it going to get? Well, thank goodness it's Friday. The weekend should be a reprieve. Tough day, tough week, tough year. The S&P 500's down 26% from its all-time high. This is a bear market. I find myself thinking about the 1970s lately, and I think something to keep in mind is that the 1982 bear market, when the Fed was fighting inflation aggressively back then, the S&P fell 28%. But in 1974, the S&P fell 48%. So I think a key question is this the beginning of a high inflationary period, or are we near the end of a high inflationary period? If you think we're near the end of a high inflationary period, the worst is largely behind, and the market shouldn't go too much further down, but that's the key question.
Yeah, that's impossible, literally impossible to predict, because I mean, we're talking about even 2 years from now, inflation could be totally different. A year from now, inflation could be totally different. Never mind 8 years from now, let's say, difference between 1974 and 1982. So I almost think it's impossible to try to even predict that, just to be quite frank. If you are betting on stocks or betting against stocks because you feel like it's the beginning of a cycle or end of the cycle, I think that's just a huge mistake. You got to be betting on companies, if you're betting from the long side, that you believe they're going to go up dramatically over the next few years, regardless of kind of if inflation's at 6% or 4% or 5% or 3%.
Feeling much better. What do you think?
All right, I'm going to try to make you feel a little bit.
S&P's longest quarterly losing streak since 2009. Wow, that is interesting.
So look, we think that the market is set to stage a major battle at the 3,500 level. And the reason for that is if you look back over the course of recessions into the 30s, a median recessionary drawdown is about 27%. And so we'll get there when we're around 3,500 on the S&P. And I still, as I talk to investors, I think many are still in the mild, kind of quicker, shallow camp, but do think there's going to be a sluggish growth backdrop afterwards. I think people are not really looking for anything major like what we had in the financial crisis. So I think that at least we've got that at our back. I will tell you, if you think about kind of where investors' heads are at, something else that makes me feel a little bit better is I'm not sensing a ton of panic, definitely alarm. But the big question of the day is, what do higher rates for longer mean for valuation multiples? And that's a very constructive conversation. And we've done some work suggesting that we're probably getting pretty close, if you hit that 3,500 level on the S&P, to the same kind of multiple contraction you saw back in the 70s over the course of the entire decade.
I want to come back to earnings, but before that, we just heard from Laura.
So she was just talking there about an important subject around kind of like fear in the market and those sorts of things, right? So I think something important to pay attention to is the VIX, right? Which everybody looks at the VIX and says, yeah, we haven't reached a capitulation stage or something like that because VIX hasn't gone 40 plus. But I think something to remember is we're still in a very elevated VIX. I mean, when you talk about VIX at 30, this is not normal at all, okay? We're in an extremely elevated market. You can get the market to bottom without the VIX going to 40 plus. It doesn't, just because the VIX goes super high doesn't mean you've reached a market bottom or something like that. It's not the way it works. So I just think it's important for everybody to understand we're at when you talk about VIX 30, you're way elevated. I mean, the VIX should usually be 15. We're basically double that. That's how volatile this market is. It just hasn't reached a capitulation crazy stage because we haven't had a shock and awe event. If we get then we're going VIX 40 plus. But without that, you're not getting that number. It doesn't just like magically happen because maybe earnings are weak or because the Fed raised interest rates. You're not getting VIX 40 plus off of that.
Short and shallow, I think you said. I think she's referring to a recession. Are you projecting a recession? And I guess my question really is, normally if you have a recession, we turn our heads and look at the Fed and say, okay, please cut rates. Do we have much room to really deal with the recession if and when it comes?
We're expecting a short and shallow recession, but we're a bit concerned that the troughs might linger well into 2023. We're not expecting a V-shaped recovery after the small recession. We think it's going to be slow, real growth afterward. The trouble here is that the Fed can't rescue us because of the inflation problem, and they can't attempt to rescue the equity market or even the economy broadly until they're confident that the inflation battle's been won. So I think people know it's pretty clear at this stage the Fed is committed to fighting inflation, and they've decided they're willing to risk a small, moderate recession, tolerate one, to make sure that this inflation beast is slain.
So if we're talking about equities, just for a moment, you got at least two things going on. One is valuations and what we're expecting, and the higher discount rate affects that. Also earnings. What are you expecting on earnings?
At this stage, we're expecting earnings for 2022 to be $225. I think at this stage, you should not expect any growth. It should be flat in 2023. But every day that goes by with the shocks that we're experiencing, higher interest rates, a super strong dollar, collapses in other currencies around the world, even oil prices have come down a lot, and we are beginning to see a lot of companies come out and say things are slowing. So the earnings risk is mounting.
What about earnings?
Yeah, I think this earnings season that we're about to get into starting next week, and then it's really going to get crazy at the end of October, beginning of November, that will give everybody very good context on where earnings are going. And are we set up in a situation where 23 is going to be a year of no growth for earnings? Or dare I say, negative EPS numbers in 2023, right? Or is it going to be a year where it's break even or maybe even slight growth? I think that's going to be the whole debate, but I don't think people are going to feel confident until they hear the earnings that are going to come out at the end of October and into the beginning of November and hear companies on their conference calls and what they're saying about the environment. That's going to give a lot of context for 2023.
We saw FedEx, we saw Apple, we've seen a lot of earnings warnings out now.
So we're actually pretty far below consensus. We're at 218 for this year versus 211 last year, and then we're actually at 212 for next year on S&P earnings. So we think this is going to be pretty similar to 2015, 2016, where earnings basically go nowhere for a couple of years. And I do think companies are much more resilient in terms of managing their business models than they have been in the past. There's a lot more flexibility, a lot more ways to suck out costs, a lot more ways to manage through. Supply chains are improving, but one thing we've been telling investors is as inflation...
Before we get into that, I love how low her expectations are. 2023 expecting down numbers. I just love going into the next year with, expectations that are down or like, it's going to be a blah year. I think that's a good way to set up. The years that scare me is when we're setting up and, everybody's expecting boom times. And then as a year transpires, like a 2022, for instance, a lot of folks were expecting 2022 to be a great year. And it's been just everything that could go wrong has pretty much gone wrong. And the environment's just gotten worse throughout the year. That's a little scary, right? 2023, as we get closer to that year, people aren't really projecting it to be boom times, anything but.
Moderates, that takes a bite out of earnings because it takes a bite out of revenue. So that's a big headwind we've got next year.
So, Lori, companies may be resilient. What about consumers? How resilient are they? And particularly tie that into unemployment, because if we do go this direction, what kind of unemployment are we facing?
So, look, I think consumers are headed into some headwinds here, and we're starting to see trade down impacts. You're seeing a lot of those references on the earnings calls. We're also starting to see a lot of impacts among lower end consumers. Higher end has been holding in much better, but we do think the consumer is going to take some knocks. One of the things that gives me comfort is when I talk to my banks analysts, for example, they tell me the starting points on various credit metrics are looking much better than they have heading into past recessions. So we think a lot of the consumer trends are going to head in the wrong direction, but they're not going to necessarily be hit as bad as they have in past downturns, just because balance sheets have been cleaned up pretty strongly over the past few years.
And we're thinking similarly, that the consumer is having a tough time. They got hit by this high inflation. They see the high interest rates affecting the housing market. But this small recession should be marked by still an inflationary environment, not deflation. And we think the labor market will be relatively okay. They will suffer some knocks, but we don't think unemployment goes up any more than 1%, where usually it goes up 3, 4, 5% during a recession. So if it's still inflation, not deflation, and the labor market holds in there largely because supply is tight, then credit conditions, credit costs, they should be benign. That should help the banks get through this very well, and that should help investors invest in credit. 2023 should be a better year for fixed income investing.
So relatively
interesting. By the way, I like this David Bianco gentleman here. I like a lot of his thoughts and the way he kind of presents himself. I appreciate that.
What we saw in the United Kingdom this week was not benign. No. There was a real break in the market there.
A lot of dislocations.
Do we have to anticipate something similar to that in the United States?
The short answer is no. However, what's happening in the UK is a shot across our bow, one that I hope our policymakers take very seriously, and that comes down to when you're fighting inflation and your economy is suffering supply-side shocks and other pressures, it is difficult to support the economy with monetary policy. They're hiking rates, the BOE, and it's difficult to support the economy with fiscal policy. They also have deficits. So the United States needs to be a lot more mindful about its deficits, whether it's tax cuts or spending. These deficits need to be watched in this time of rising interest rates.
So, Lori, one more.
And it's interesting. I was just covering inside the private stock group earlier today. I was, explaining the 5 kind of core parts on why the Fed can't keep interest rates at, let's call it, a very elevated level for a long period of time. And part 1 of that was basically the government debt. And basically, when we're talking about substantially raising interest rates, you're talking about hundreds of billions of dollars more of interest the government has to pay on that debt. And you kind of create a very bad dynamic. And that's just one of 5 different components there. But I think he brings out a good point.
In a broader perspective, a great financial crisis is what we're all afraid of.
Right.
We're in better shape going into this, whatever this is, than we were that time, right?
I think we are. I mean, we again go back to our banks analysts who spend time scrutinizing the balance sheets of the big major banks, and we think the plumbing is in much, much better shape. I mean, the way I put it is the stress tests do appear to have worked. That's one of the reasons why banks haven't really been able to grow in recent years, but it is also one thing that I think is going to really be an asset to the financial markets in coming years.
And we're overweight the banks.
And those stress tests, remember, if I recall, even Jamie Dimon complained about the stress tests and how it was too rigorous and it was too out of the norm. It seems like almost the Fed kind of looked at that and was like, "Wait, we're gonna do some major stress tests here and really put you guys through it." And so I think it's better to be safe than sorry. Let's put it that way. It's better to be safe than sorry in regards to the banking system, because if you want to know why 08, 09 was so incredibly vicious, not just for the housing market, but for the stock market and for the economy, there's many various reasons, but a huge part of that reason was how bad the financial sector was tore up. And coming out of that, I mean, everything was a mess. Real estate, stock market, trying to get a loan, everything was a mess coming out of that whole situation. And so therefore, it created such big problems for everything. And that's why those stress tests are very important.
This week.
But on the banks specifically, that's great on the banks, which is up to all the regulation. What about the part that's not subject to regulation? What about the shadow banks? What about the private credit issues? We don't necessarily know what's going on there, right, David?
Well, there's some debt in the system because debt was so cheap and readily available for the past 10, 20 years. But the banks, just as Lori said, we're confident that their balance sheets are strong. Higher interest rates, they should make higher net interest margins provided their credit costs don't surge. But a resilient labor market, home prices may come down a little bit, but as long as they don't collapse, people will keep paying their mortgages, particularly if they locked in the low rates from before.
Yep. Exactly. Yeah, especially in regards to rates. That's the one good thing the real estate market has going for it right now, is how many people over the past 2 years, essentially, basically right after Rona, all the way through February of this year, how many people refinanced their mortgage or got a new mortgage if they bought a new house are at an interest rate of 2 or 3%. It's a ridiculous amount of the population is at a mortgage rate of 2 or 3% now at this point in time. And that definitely gives a strong, we're definitely going to be in a stronger real estate market going into this whole situation that we're in right now compared to obviously what the situation was in 08, 09, which was very different. Let's keep in mind, in that scenario, we had countless people that were on these balloon payment type deals that were variable rate, and all of a sudden payments ballooned on them and they couldn't literally pay it, right? Versus now, massive amounts of people are on fixed 30-year mortgages at 2 or 3%, right? And a host of other people, over the past year or two, did either 5-year ARMs or 7-year ARMs that aren't coming due for a long time in the future. And obviously, the interest rate environment can differ massively just year over year, never mind 5 years in the future and 7 years in the future. So that's the one component that's really good for real estate. And that's why I'm not expecting a full-blown, I guess you can call it, crash in real estate prices. I'm expecting every single market pretty much to see real estate prices go down. And obviously, cities like I live in Vegas and where I got another house in Phoenix, markets like that will definitely be hurt. And hurt in a pretty big way. But in terms of those like 50% type declines we saw in the great financial crisis, I think that's I don't think it's impossible, but I think it's going to be very, very difficult to get to there, okay? All right, let's get into this one. Warns of scary October, okay.
For the drift right now on the markets, what they're telling us, I know your old boss, like to focus on them because they oftentimes were hitting records. Not so right now, but we're told this.
His old boss was T-Man, if I recall, okay? 45, if I recall.
The president doesn't bother obsessing about them. But now that they're underwater in his presidency, I would imagine he's at least aware of it.
That's important. Did you hear what he just said there? That's important.
Not so right now, but we're told this right now on the markets, what they're telling us. I know your old boss, like to focus on them because they oftentimes were hitting records. Not so right now, but we're told this president doesn't bother obsessing about them. But now that they're underwater in his presidency, I would imagine he's at least aware of it.
In terms of the current administration, they don't care as much right now. It's not a presidential cycle we're in right now, right? And it hasn't gotten bad enough where it really reached kind of critical level or mass. And also, I feel like the media hasn't really put the pressure on there, to be honest. If let's say it's getting ready for the next big election cycle and the stock market's down a bunch, that's a whole different dynamic there, right? And you have to start caring if you're on that side. But for right now, they kind of like, it's not the biggest deal in the world. And the media is not putting that pressure. If the NASDAQ was down 33% under the last one, I think there'd be a lot more media pressure, just to be quite frank. A lot more, and it wouldn't even be close.
Right. One would hope, but, I've been surprised about the things that President Biden and his team are not aware of. The fact is that a president should focus a lot on markets. And the reason is that markets, as you guys just discussed, are forward-looking. And so markets, if they see a turning point coming or if they see a pit of despair coming, then you see it in the market today. And right now, the markets are down enormously. I guess we haven't seen today yet, about 23% for the year. And I don't think that that's, anywhere close to the bottom because the Fed is going to continue to raise interest rates and the White House is going to continue to be in denial. I absolutely think that President Biden should be looking at the markets. He should be thinking about why the markets are rejecting his policies, and then he should think about adjusting those policies. And until he does, then I don't really think we're going to see a bottom.
Kevin, if I could switch to what's happening abroad.
So obviously, I don't care about, who's on what political side, but obviously what he was just saying there is political points. B-Man can't do anything about the current situation with the Fed. They have to raise rates. And in regards to, inflation, like he's not going to magically fix, commodity prices and things like that. It's not the way it works. So I just think those are some things to kind of keep in mind. Obviously, whenever you're dealing with somebody from either side, they always put these unrealistic expectations on it. And I saw it obviously with Obama back in the day. I saw it with obviously Trump, and unrealistic expectations they put on him. And now Biden, and they always expect the president could magically fix everything. And it's like, some of this stuff is not, let's just call it in their realm of capacity to be able to magically fix it. Like, woo, there I did this. I did some policy and it fixed everything. It doesn't work like that.
Skip across the pond to Britain right now, where the Bank of England is saying it would not hesitate to change interest rates by as much as needed to bring down inflation. And what was rattling the British markets today, as we're rattling them last week, were these latest proposals on the part of Liz Truss, the new prime minister, to rein in or try to rein in what's happening on the energy front, where utility bills for about 80% of Brits are so overwhelming that a lot of them can't pay them. Right. And she's offering tax cuts, but the tax cuts apparently are being deemed inflationary by the markets and would make a bad thing even worse.
Now I'm hearing they're pulling that back, which is interesting.
Interesting take on that. I wonder what yours is.
Right. Well, I think that, the fact is that you get inflation when there's a lot of demand, like we mailed checks to people, and supply is constrained, as it was here, both because of the pandemic and because of Joe Biden's excessive regulation and tax hikes. And so if you look at the way Ronald Reagan and Paul Volcker defeated inflation, they not only had high interest rates, but they also had supply-side tax cuts. And
this is why I hardly ever react to Fox Business, just to be quite frank. You know, it's clear what side they're coming from, and everything's got to be about politics. And it's like, you know, come on, man, let's focus in here. Like, oh gosh.
Reduction in discretionary spending, it dropped more than 20%.
If CNN had a business channel, I wouldn't react to that either. Okay.
Beginning of the Reagan administration. And so if you want to fight inflation right now and you're serious about it and you're a student of history, then what you do is you have supply-side tax cuts, but you pay for them with big reductions in government spending, and you have the Fed do what the Fed's doing. And so right now the Fed is going alone. It's rowing with one oar. Fiscal policy is in denial and actually going in the wrong direction with, say, the student debt forgiveness. And so in the U.S., you know, we're not anywhere close. In the UK, I would like to see a little more fiscal responsibility, but I think the supply-side tax cuts are a good because basically you got to get more supply if you want to get ahead of the curve on inflation, and I think Liz Truss is right to try to do that.
All right, of course, the Reagan distinction there notwithstanding, the fact is that deficits did balloon as time went on, and a lot of revenue came into Washington, as you accurately pointed out, but politicians being politicians proved very able to keep spending that revenue and then some. Do you worry that if Republicans take charge, not that you would worry about that, we could face
Welcome to America.
Just a problem of a different stripe here?
Right. Well, I think that what's going to happen if Republicans take charge is that we're going to see, you know, is Joe Biden able to work with Republicans or not? And if he is, there are a lot of sound things that, you know, perhaps Speaker McCarthy has planned for next year, because they understand that it's time to act. It's time to make sure that the expiring Trump tax cuts don't expire and to get more fiscally responsible. I can say as an economist, if you look at economic history, it tends to be the times when we have a divided government that markets are happiest and that policy is the most sensible, because it's only sort of sound ideas that can get enough votes from both sides to go through. And so I would actually say that if Republicans capture the House, that within a few days of that would be about when the stock market would bottom. But October is going to be very, very scary in markets. It's going to be a lot of volatility because people are going to be worried that it's going to go this way or that way. And if there's a little bit of good news for Democrats and people think that this really profligate spending and, you know, attacks on the supply side, it's going to continue for 2 more years, that I think that the market's going to have to think, well, the Fed's going to lift rates to 8 or 9% because they're the only game in town. And so I actually think that we're going to have a really terrible October, and that we'll probably hit bottom if Republicans capture Congress.
So do you think part of this sell-off that's been happening and building momentum has to do with that prospect that Republicans don't do as well in the midterms? They might take the House. It doesn't take a real big leap for that to change. But anything else bigger, or certainly like a 1994 Gingrich revolution wave, doesn't happen. And that's being partly reflected in what the markets have been doing.
Right. I think that absolutely you're right, that the market has been surprised by Fed policy, and the market has been, I think, surprised by the comeback of Democrats in the polls. I think that's probably attributable both to the sort of soap opera of President Trump, the attacks on him, and also because of, abortion being such a hot button issue. But, this election is going to be about a lot of issues. But as an economist, I could say that if you want the economy to turn around, you have to stop this socialist nonsense that Biden and the Democrats have been doing for the last 2 years.
Okay, so obviously that's why I don't react to Fox Business stuff. Yeah, I mean, it's just so obvious, kind of what the agenda there is being pushed, and everything goes back to politics. And I can tell you the market moves very little off politics. It moves some, but it actually much less meaningful. The market moves on. that's just the way it is. So anyways, guys, much love as always. Appreciate you joining me, and have a great day.